The greatest wealth transfer in history is coming. The next 3 years will see the largest wealth transfer in history. That means now is not the time to blindly hand over your money to Wall Street or bury your head in the sand. In today's video, we'll be sharing with you the latest wave on the largest wealth transfer. So make sure you stay tuned till the end. The US government on Thursday updated its estimate of the country's economic performance in the April-June quarter and confirmed what it had reported last month. The economy shrank for 2 straight quarters. 6 months of contraction is a long-held informal definition of a recession. Yet nothing is simple in the post-pandemic economy. Growth may be negative, but the job market is strong. The economy's direction has confounded Federal Reserve policymakers and many private economists since growth screeched to a halt in March 2020 as COVID-19 struck and 20 million Americans. While most economists and Fed Chair Jerome Powell have said they don't think the US economy is in recession, some analysts still predict that an economic downturn will begin later this year or next. But even as the size of the economy has been shrinking, American households have been getting richer. And not just because stock prices have soared to record highs, paid by billions in stimulus checks and near zero interest rates. The next recession is shaping up to be the biggest wealth transfer in history. As prices for essential goods continue to rise, many Americans are feeling the squeeze. With wages lagging behind inflation, people are finding it harder and harder to make ends meet. Walmart, the nation's largest retailer, has reported that higher gas and food costs have forced its shoppers to cut back on discretionary spending like new clothing. This is a clear sign that consumer spending, which is the main driver of the economy, is weakening. The Fed's rate hikes have helped send the average 30-year fixed mortgage rate up to 5.13%, compared with 2.86% a year ago, making home buying increasingly unaffordable in the US. Higher rates will likely weigh on businesses' willingness to invest in new buildings, machinery, and other equipment. If companies reduce spending and investment, they will also start to slow hiring. Rising caution among companies about spending freely could lead to eventually to layoffs. If the economy were to lose jobs and the public were to grow more fearful, consumers would further reduce spending. Homeowners with mortgages would see their home equity decrease. Renters would benefit as landlords struggle to keep up with mortgage payments and are forced to sell their properties. The Fed's rapid rate hikes have raised the likelihood of recession in the next 2 years to nearly 50%. Goldman Sachs economists have said, and Bank of America economists now forecast a mild recession later this year, while Deutsche Bank expects a recession early next year. This is all setting the stage for what could be the greatest wealth transfer in history. In a recession, stock prices usually fall and bond prices rise as investors seek safety. That means those who are invested in stocks will likely see their wealth decline, while those who are invested in bonds will likely see their wealth increase. Of course, not all recessions are alike, and there is no guarantee that this one will follow the typical pattern. But if it does, it could lead to a huge shift in the distribution of wealth in the United States. So, what can you do to protect yourself from this potential economic disaster? For starters, you should consider paying off your debt as soon as possible. This will reduce your exposure to creditors in the event of a recession. You should also think about diversifying your investments. This means putting some of your money into assets that are not susceptible to economic downturns, such as gold or real estate. The poor would suffer the most as their portfolio values drop and they face higher borrowing costs. In the end, the Fed's rate hikes could lead to a recession, which would hurt everyone. This potential economic downturn comes at a time when American households are already struggling with record levels of debt. The typical household now owes $137.63, which is up nearly $1 trillion from just 3 years ago. All of this debt is a ticking time bomb that could trigger the greatest wealth transfer in history. As Americans default on their loans and declare bankruptcy, their assets will be seized by creditors. This includes not just their homes and cars, but also their retirement savings. Home prices have surged too. so have the value of art, classic cars, and other collectibles. A recent survey found that 1 in 4 Americans expects to receive an inheritance in the next 5 years. In all, households are on track to receive the largest transfer of wealth in the U.S. history, $68 trillion over the next 2 decades, according to Boston Consulting Group. It's gonna be unprecedented, says David Bassanis, chief economist at BetaShares Capital Management in Sydney. There has never been anything like it. The last time there was a comparable shift of wealth was in the years after the World War II, when the baby boom generation was just getting started. But even that pales in comparison to what's about to take place. This is going to be much bigger, says Paul Desmarais Jr., co-chief executive of Power Corporation of Canada, a financial services conglomerate. In the United States, the baby boom lasted from 1946 to 1964. In Canada, it started a few years earlier and ended a few years later. But in both countries, the post-war period was characterized by rapid economic growth and expanding middle-class prosperity. It was just an unbelievable time, says Desmarais, who is 61. The economy was booming. Jobs were plentiful. It just seemed like everything was possible. In the US, the median household income more than doubled between 1947 and 1973 after adjusting for inflation. In Canada, it tripled. Much of the wealth created in those years was transferred to the baby boomers as they came of age and inherited businesses, real estate, and other assets from their parents. But much was also lost. Inflation erodes the value of savings, and stock market crashes in 1929 and 1973 wiped out billions in paper wealth. The top 10% of Canadian households, those with net worths of more than $4 million, are on track to inherit an average of $7.4 million each, while the bottom 50% will receive less than $50,000, according to a recent report by CIBC Wealth Strategies Group. In the United States, the wealthiest 10% of the households will inherit an average of $11.2 million each, while the lower 50% will get less than $25,000, Boston Consulting Group estimates. It's gonna exacerbate inequality. Bassanis says, the people who have done well are gonna do even better. The uneven distribution of wealth is one reason why some economists are worried about the potential impacts of the upcoming transfer. If you concentrate that much wealth in the hands of a small number of people, it can have all sorts of adverse effects on the society, says Lawrence Kotlikoff, an economic professor at Boston University. Inherited wealth can lead to intergenerational dynasties, he says, with children born into wealthy families benefiting from their parents' and grandparents' success, while those born into poor families fall further behind. It can also lead to less innovation and risk-taking as people become more focused on protecting their wealth than on creating new businesses or products. You end up with less mobility, less social cohesion, and ultimately slower economic growth, Kotlikoff says. Of course, not everyone is worried about the coming transfer of wealth. For one thing, it's not clear how much of it will actually be realized. Much of it is in the form of assets such as real estate and closely held businesses that can be hard to value and even harder to sell. And even if it is realized, there is no guarantee it will all end up in the hands of a few wealthy families. People who inherit money often don't keep it, Baskin says. They spend it or give it away. In the United States, for example, the wealthiest 10% of households hold about 70% of the country's wealth, but they also account for about 60% of its charitable giving, according to Given USA. And not all transfers of wealth are bad for the society. For example, Bill and Melinda Gates have pledged to give away most of their fortune, an estimated of $89 billion, through their foundation. There are a lot of people who are gonna do good things with this money, Baskin says. We shouldn't assume that it's all gonna end up in Swiss bank accounts. So while the coming transfer of wealth is likely to exacerbate inequality, it's not clear how much of an impact it will have on the society as a whole. It's a big number, but it's not the end of the world. Kotlikoff says, we'll adapt. This event will have wide-ranging applications for the economy, social programs, and intergenerational relations. It's important to be aware of the coming transfer of wealth and to plan accordingly. So that's all for today's video. If you liked this video, then give it a thumbs up. And if you want to watch more videos like this, then hit the subscribe button and turn on notification so that you will always be notified.